Hi guys, my name is Angela Rossi from Coldwell Banker Ronan Realty. I want to welcome you to my YouTube channel. Today we'll be talking about everything related to mortgages, and we'll try to touch base with more videos. So if you end up having any questions that we didn't touch base on, please feel free to message below and we'll be more than happy to address it with another video. If you like the content that I'm providing, please hit the subscribe button below and click on the bell notification button to be able to be alerted on when my next YouTube video will be released. Thank you, and I hope you enjoy the content. Today, I have a very special guest with me, Lisa Purchase. She is a mortgage broker, and we're going to be touching base on anything associated with mortgage. Lisa, hi guys. So today we're going to start off by starting with the basics. Let's start with when is a good time to reach out to a mortgage broker, and what's the difference between going into your bank and getting a mortgage as opposed to somebody reaching out to yourself?
Okay, so if I could wave a magic wand, everyone would come to their mortgage broker first. Don't want to waste any time falling in love with a dream house that you cannot afford. There is nothing sadder than that when clients come to you and they just can't afford the house. Also, I'm able to help you if there's any problems with your credit score, if there's any problems with your income documentation. I can help you right from the get-go, get everything in the absolute best position so that when you do find that house that you're in love with, you're ready to make that offer and you're ready to make a good, solid offer that is going to get accepted, especially over the last couple of years when houses were going into multiple offers, they were going well over asking, everything was a battle. You want to be prepared. The more prepared your clients are, the more success they're going to have. The difference between a mortgage broker and a bank, banks deal with what are called A mortgages. Those are for your squeaky clean clients, the best credit, the most solid income, long-term salary positions, such no hiccups. Mortgage brokers also deal with A mortgages, but we also deal with alternative and private mortgages. So if you're not squeaky clean, if you have a few blips on your credit history, maybe you're business for self, and so you don't show all of your income on your taxes, because why would you put all the work into your own business and not use the legal tax deductions? We can use other lenders that can get you approved for the mortgage to get you into your house, all with one stop. You're taking your documents to one person who's supporting you the whole way, rather than having to go from bank to bank and finding out if you've got their best product or if you don't qualify for their best products.
That's awesome. Thank you. Actually, speaking of, so when it was very hot and, there was multiple offers, I actually want to address this situation because I felt like a lot of people were going in without a mortgage condition. Did you find that that was a good idea? Was there any bad situation that you're like, oh no, this, like, don't do something like that? And what's the risk in doing something like that?
So it is absolutely terrifying for us when clients go in without a condition of financing, because clients can be fully approved, but the property may not be. And your clients would have no way of knowing that. So we did actually have an example in our office of an area that the people had bought in and the house was red flagged. The clients had done nothing wrong. The clients were great credit, great income, A all the way clients. The house could not get approved. They could not get a mortgage on that property. Had they not had a condition of financing, they're at risk of losing their deposit on offer. They're at risk of being sued if the purchase doesn't go through. If there are any followers in the daisy chain of sales and purchase, they can be liable for all those people when the case goes to court. So it is a huge, huge risk. I mean, there's the two risks that were being overlooked: the condition of financing, the condition of home inspection.
Yeah.
Both of those are put in place for the safety of our buyers.
That's right. I agree. Honestly, I think the US has an escrow,
Yes,
but Canada doesn't.
Yes.
And I believe, honestly, this is a mandatory thing. And it is really difficult. I've had clients during that time that were like, no, we're never waiving the home inspection and the insurance. Like, I want them in there. And it was great. And I said, no problem, we're going to put them in there. But we weren't getting anything. And to the point that they said, okay, well, we have to do this. I was actually shocked about how many actually closed without issues.
Okay, so the secret to that, parents or grandparents are going on title with their children. when there is not enough income on the file, when there is not enough down payment for the children to qualify on their own, especially when appraisals come back lower and they need more down payment, things like that, houses are turning into a family affair.
Oh, I see. So what would have happened? Let's say if somebody was pre-approved and then the property was only approved less than their approval amount. How does that work?
So the lenders will only lend on the appraised value. So say the property was purchased for $800,000,
Okay.
but the appraisal comes in at $700,000. Lenders will only lend on the $700,000.
Even though they're pre-approved for 800.
Even though they're pre-approved for 800, lenders will only lend to the value of the property because, again, the clients are one part of the equation, but the property is an equally important part of the equation. The banks and lenders, they all have to look at a worst case situation. If the clients do not or cannot make their mortgage payments, can they sell this property within 30 to 60 days?
Got it.
They don't want to be property owners. They want to be mortgage holders.
Got it. So in that event, they will only lend, let's say, up to 700, and then if they can't come up with that extra 100,000, then they won't be able to close on the property.
And that's a situation where they will forfeit their deposit on offer, and they are liable for what the house then resells for. If the house resells for a lower purchase price, they'll be liable for the losses to the seller.
Yeah. Hopefully now that things are shifting in a different direction, I am starting to see more conditions coming on the properties that I'm working on.
Yeah.
And frankly, honestly, I'm kind of thankful for these coming back in, because like you said, we're liable, and you don't ever want to be in a situation where, you know, you're having, or your client's coming to you and saying, oh my God, we can't close, we don't know what to do.
Yep.
I ended up having one closing that when I ended up selling the property at the highest value that that home ended up selling for. The agent called me and she said the property is not appraising. At that time the market was increasing week by week, day by day.
Yeah.
So luckily, you know, they fought to be able to get another mortgage appraisal done closer to the closing date.
Yeah.
And by that time, the market value has kind of caught up to it. So the bank did end up appraising it. But for a period of time, that was the most uncomfortable situation to explain both buyers and sellers, right? Nobody wants to be caught in that situation. Like my sellers were like, okay, I understand we can put it back on the market, but we don't want to go through all of that again. We don't want to go through showings and having to do all of that. So they were stressed at the same time, especially because now they're at a position where they just bought something and they need it.
Yep.
They need that house to close.
Yep.
I want to actually touch base on one more thing. In the event that somebody purchased something else and they need to rely on the money that they close, is there a scenario where the bank will kind of help them in that situation if it's not their fault that it?
So the banks won't. Alternative or private lenders will. So what I had in a few situations where clients had purchased a new house at the height of the market, and were selling their house, the market fell off, their current property was not selling in time. We were actually able to put a blanket mortgage over the two properties. They've kept their current house as a rental property, and they were able to purchase their new home and close on the new home with the plan that in a year or two, when the market comes back up, they'll be able to sell the house that was their original house that is now a rental property and be able to get into a better mortgage.
And is that something that, like, normally does that mean they're paying really high interest rate for that bridge?
Yeah, it's a complicated file, which means that you're paying complicated interest rates. So you're looking probably in the 8 to 9% range.
Wow.
Yeah. But the alternative was, again, losing the house, losing the deposit on offer, and being sued all the way down the line.
Yeah, that would definitely be a way worse situation than having to bite the bullet.
Yeah.
So you had to go to, what's the difference between A lenders, B lenders, C lenders? Like, I know it kind of goes down, you know, is it A, B, C, D?
Pretty much.
Okay.
So basically, now when people think of a bank, they think of the ones that we see on every street corner. There's actually 80 some banks in Canada that are registered banks, and they're regulated all the same. All that it means for a bank is that they do mortgages, but they take in deposits. There are then also monoline lenders that just do mortgages, and they sell those mortgages on the bond market, and that's how they get their money. So depending on how the lender gets their money is how flexible they can be with their money. So an A lender would be, again, the big ones that you see on every street corner, also the other 80 that are licensed across Canada. Monoline lenders can be A lenders, or they can be alternative lenders. Alternative lenders are just more flexible in what their regulations are. A lenders have a very strict box. You fit in it or you don't. Alternative lenders offer more variety. They will look at things like maybe you have a lower credit score. Maybe you've had a consumer proposal. Maybe you're business for self and you need to use bank statement income instead of just your notice of assessment or taxable income. And the privilege of that is that it costs a bit more. The interest rate is a bit higher and there is a lender fee. The next step would be C lenders, which would be private lenders or mix. And they're even more flexible in what they'll accept. Usually they're just looking at the property and they want you to have 20% equity in the property. But again, the interest rates are higher and the fees are higher.
So let's talk about, I think we're going to go through some very hard times, and I think it's important to address. Let's say somebody is caught in a situation where they start defaulting on their mortgages. How does that look like? When does the bank repossesses their home? What should they do? Should they get in contact with you ahead of time? What would you advise somebody that's starting to fall back on their mortgages? I guess that would be the best way to word this question.
So the biggest thing to remember, banks and lenders do not want to own the property. They want mortgage payments. And as long as the client is going through troubles, the bank will try to work with them. They will make situations, they might do lower payments, they might increase different funding facilities, different things. There's lots of options. The worst thing that a client can do is just ghost the lender, not respond. Lender has no idea what's going on. Lender has no option except to go power of sale or foreclosure. As long as the client has 20% equity in the house, we have lots of options. We can refinance them. We can prepay the mortgage. We can pay out other debts that are holding them back. We can do lots of different things. That magical number is if you own 80% of the value, 20% of the value of your house and you have 80% or less owing, we have lots and lots of options. If you bought and you are a high ratio or an insured mortgage, that's where you had less than 20% down, that does get more difficult. The best thing you can do is speak with your mortgage broker and speak with your lender, because again, nobody wants you out on the street. They want to have you making your payments.
Okay. If somebody did go and get a mortgage through a bank and now they're starting to struggle and have issues, do you advise them to go to their bank? Is there a difference would you recommend they come and speak to a mortgage broker, like to see options? Or is it if they're fixed into their bank, they have to stay with their bank and find the alternative?
No, they never have to stay with their bank. You have the flexibility to go wherever you like. I, of course, obviously, I advise speaking with a mortgage broker because we do so much more than just the mortgage. We help with debt consolidation. We have access to resources for that as well. And we can help with credit scores, things like that. We can even help refinance your car if we had to. We do have this whole tool belt of options all in one place. And this is what we do for a living.
Yeah, that's awesome. So the other topic that I kind of wanted to touch base on is mortgage renewals. In the event, your bank, do they always send out a notice that you have to renew?
Yep.
Okay, and do you have to renew with them?
Absolutely not.
So do you advise, because right now a lot of people's mortgages are coming up and their rates are going from down here all the way up here.
Yeah.
So are there some lenders that are being competitive during this time, or is everybody bringing up their rates?
So everyone's rates are going up right now. That is just across the board, and that is just because of the cost of money has gone up from in COVID. And the banks are going to pass that cost on. The lenders pass that cost on to the clients. I recommend going to a mortgage broker because we can look at a whole bunch of different alternatives. Banks are fabulous at what they do, but they only have one or two products.
Okay.
We can have 1 or 2 or 3 products from 80 different banks and 20 different monoline lenders and all these options that you don't have to fit into one box. We've got a whole assortment of boxes.
Okay, I think those are all the questions that I might have for you for this video.
Okay.
Anybody, if you guys have any questions that we didn't touch base on, please leave comments below. We're more than happy to make another video and address any of your questions or concerns. But thank you guys. I hope you enjoyed the content. Thank you, Lisa,
No
for joining
problem.
me. This was absolutely awesome. And I think it's very educational, and I hope everybody loves it. We'll see how it goes. And then everybody from home, thank you guys for watching. We hope to see you next time. Hi guys, if you want to get in contact with me, please click on the link below, click on Let's Connect, and then go to buyer consultation, seller consultation, or discovery call.